Good morning, ladies and gentlemen. As always, we start the review with the fixed income market in the States, and we had a completely uneventful week. As we can see, the 0.382 retracement in the 5-year notes, in the yield of the 5-year notes around 167 is yet to be tested, and the 200-day moving average is coming up fast and has met it. We are now at a very important juncture over the next couple of weeks. Do we break the 200-day moving average and go lower, or do we find support at the 200-day and move higher in yield? Well, we have absolutely no idea whether we will manage to break it on the downside, but I think we will give it a good go. It has been quite remarkable how well bid the futures market has been in fixed income. If we look at the 10-year note and the yield, same picture. The 5 and the 10s are very stable against each other. The yield curve overall keeps on flattening, which is a sign that there is very little stress or very little fear that that yields will go up at any stage soon. Now, those fears could very well be ignited by some event, but at the moment we are very comfortable trading very close to the 0.382 retracement and the 200-day moving average. But this state of affairs cannot last. The 200-day moving average is coming up fast. We will either break it to the downside and fill these gaps around the 2% mark in the 10-year, or we will go back up towards the 260 within the next couple of weeks is going to be crucial for the 5-year and the 10-year. The 30-year, and especially when one looks at something like TLT, certainly has room to come up to at least 126, 127 before it makes the same, has to make the same decision. 127.37 is going to be a very, very important level that we will definitely short because it's a very good risk reward area. So we have marked it 127.37, and from there we will see what happens. But it's not surprising that absolutely nothing is happening in the fixed income market, because we still don't know. Well, we've discounted a very high probability of a move by the Fed in June, but on the other hand, the price pressures keep on alleviating, and this is the famous chart of all the commodity indices that we have, with the very important levels that if we break, we think are going to drive yields much higher. There is absolutely no sign of that happening at the moment. Neither the precious metals nor oil nor any other component of the commodity indices is making breaks to the upside, and therefore the price pressures are almost non-existent. If we look at yields in Europe, much the same picture. 2-year note on a weekly, it is basically unchanged and has been so for the best part of a month. It's trading within 2 or 3 basis points range. The 5-year, the bobble, again has been in the same range for 5 weeks, and this is such a narrow range, it's almost unbelievable, from -40 to -25, let's call it. So a 15 basis point range for the best part of a month and a half is almost unheard of. Volatility has collapsed. Nothing is happening in Europe at all. All they are, this is the Bund, this is again from from plus 45 to plus 30, 15 basis point range. Our favored break is still to the upside, but it probably will be postponed until we get some indications of immediate actions by the ECB in terms of ending QE. At the moment, it is just summer doldrums starting early. We think the likelihood is greater than not that we test the downside around the plus 15 area, but that is all we can hope for on the upside in the bunds. Since the States and Europe have been trading in lockstep, i.e. doing nothing in their differential in fixed income, it is not surprising that the dollar has done absolutely nothing last week. We still have this extremely important level of 96.50, which, if broken to the downside significantly on a weekly basis, let's say, could open a move to much lower levels around 92, 93. But we think at these levels the likelihood is greater than not of a reaction move up towards 99 in DX before we have some more 99 to 96 range trade. Certainly that is the message from a weekly chart of the euro against the USD. We have made this very strong move up. Last week we did nothing, and we sort of made a small hammer, which we don't think is very significant, but tests around the 110 area are more likely than a continuation of the move up right now. So moves towards the 110, which will probably equate towards the 98, 99 level in DX before we turn these moving averages significantly. This might take certainly 4, 5, 6 weeks before we decide on the next move, which we still think is going to be higher because we think QE is ending in Europe, and that should drive yields higher in Europe compared to the States, and should underpin the Euro USD for certainly retests of 115 to 120 area over the latter period of this year. Moving on to equities, we are and remain puzzled. This is one of our most important early indicators for XLF, and as you know, XLF is 20% of the S&P and a very important component, especially in the Russell. And XLF is certainly not doing what we expect. As we've said to you, basically you look for a break of 24 or for a break of 22.85 on the downside to give you the next several percentage points in XLF. The lead is the yield curve, which is flattening still and therefore reducing forward earnings in XLF. So we still expect this break to come to the downside. That would certainly drag all the indices quite a bit lower, but it's just not happening. So the bond market and the equity markets are at record divergences in terms of expectations. This is a completely unsustainable position. Either the yield curve will snap back or XLF eventually will give up the ghost and indices will follow XLF. When things like this happen, it is best just to stick to your knitting, trade very small, trade with very tight stops, and probably even not trade. I mean, our our job is to give you important signals when they occur, and also to warn you of the consequences of those signals. If nothing is happening, the best thing that we can do is to tell you to do nothing, because there is nothing to be done. This just cannot survive much longer in terms of spread of divergence. It will break one way or the other very severely, and when it does, it'll catch people very unawares who don't know that this is happening. And believe me, most people out there do not look at something like this. We look at a variety of spreads to give us our risk on or risk off parameters. This is one which is telling us absolutely nothing. This is probably the most important one, which is SPY TLT. It has been stuck in a very, very narrow range since the beginning of the year. You can see that it's basically traded sideways since the beginning of the year, saying basically that S&Ps and TLT have moved almost in lockstep in terms of appreciation or depreciation over the course of these first 5 months. It is something, again, which is unsustainable. After a period of such tight action, there will be either a thrust higher or a break to much lower levels as the market goes to risk off. At the moment, we have no indication of what is going to happen, but this kind of move in which is so small and so sustained for 5 months tells us that when it does happen, it will be quite large. Another very important indicator of risk on, risk off is XLP, XLY. So basically consumer staples against discretionary. And this is again a market which has done nothing since the beginning of the year. It is exactly at the same level as it started the year, which we find quite incredible. It tried to make new lows, i.e. continue for the risk on move, but it has failed. It is now in completely indecisive territory, and we await for developments there. We still think that the risk on move is more likely than the risk off, but while it is here, it is telling us absolutely nothing. And this is a chart of emerging markets against SPY. They did very little last week. Even they survive Brazil very well, so that gives us some comfort that we will test and probably break these very important levels to the upside, which would unlock quite a large move towards let's call it this kind of level, this kind of retracement over the course of the next couple of years. So this chart is definitely telling us to avoid expensive US equities if possible and buy cheaper emerging markets. This is becoming a very interesting spread. It's HYG, so junk over TLT. If we are to get a higher level of valuations in equities, we have to see a break up in this relationship between HYG and TLT. We are very close to it, but we are watching it very closely for what it might portend for both the yield curve and for equity valuations. It is very unlikely that we stay much longer here. Again, we have been here all year. We would like to see a significant break either to the upside or to the downside. A break to the downside will signify enormous risk off, and we will probably go back to the levels that we were pre-Trump, or we break to the upside and we break a 11-year downtrend line, and then we can go significantly higher into those 90s, which would be quite a big move. And the move will probably be triggered by higher bond yields and narrower spreads, so you would have a true risk-on move, which at the moment you don't have. So far we have shown you how the risk-on, risk-off parameters have actually been remarkably steady since the beginning of the year. There have been absolutely no movement in them, yet the market is significantly higher. How can one explain that? Well, one can explain that simply by this chart. This is the ratio between XLK technology and SPY, which is the rest of the index. It is the one that is moving. It started the year here and has made a significant move up over the course of the first 5 months. 99% of all the gains in the indices are coming from technology stocks. Well, yes, it does make sense because technology is what the US is really good at. So can you short technology? It looks like you definitely can't. Is it overvalued? Who knows? It can be certainly much more expensive than it is at the moment. It seems to be trading very well in this channel. This channel comes up much higher, so we could continue over the course of the summer in the technology sector, basically driving prices ever higher. Since technology is the one that's moving, it is logical that we should stop really looking for S&Ps to give us any kind of insight into what is going on and switch to the Nasdaq 100. The Nasdaq is just in trend. Every time it pulls back, there are a multitude of buyers. It is on daily, weekly and monthly time frames way above the Bollinger Bands, and that is a situation which has always proved unsustainable in the past, and the market has always retraced back towards the middle of the bands. The retracements could be quite sizable towards the 5,200 area on any bad news in the technology sector, but we think that is far too early. It is more likely to accelerate upwards and then do a sharp correction of the magnitude of 10 to 15% from much higher levels. And that is why it is so difficult at the moment to trade the market, because every time you think that S&Ps have a reason to come down, the technology sector doesn't allow them to come down, then the technology sector gets squeezed higher, and that squeezes the S&Ps themselves. People are very wary of being outright short in XLF, even though they should be outright short in XLF when the Nasdaq is going up percentage points per day. So people do not do what they should be doing, and that is why the market becomes so hard to trade and so illogical at times. If we add these trend lines to the chart of the Nasdaq, we can see that now we're beginning to get acceleration. Acceleration lasts for longer than you can stay liquid. So we would be very surprised if this is the end of the acceleration. It's probably nearer to the beginning of the acceleration. We could easily see another 10-15% move in the Nasdaq to the upside before the market just exhausts itself and comes straight back down, probably for support on this lower trend line. So we are probably many months away from that kind of price action happening. This tells us that Nasdaq will continue to hold in S&Ps and drive the market higher, against its will most of the time, but it will be dragged kicking and screaming to the upside. Our biases for next week have not changed very much. The 5 and 10-year note still have very important appointments at 119.03 and 126.30. What they do there is going to decide trading for several quarters ahead. Bunds and bobble over, just like the 5 and 10-year note. Very poor risk reward being short or even long, because they're in such tight ranges. Would much prefer to go with the flow once they break that range. What is important is the commodities are doing nothing, and there is no sign of the reflation trade working. Going on to equities, well, ES has in the tank whatever NQ has in the tank. We think that we will be very grudging buyers of ES on dips, simply because NQ will make us do so. We have tried several times to anticipate a turn in NQ against ES, and we've realized that it's actually pointless. The acceleration is probably now just starting and can get much sillier. Believe us, we have seen markets which have been much sillier. So basically it's going to be a factor of watching NQ, and every time it dips and stabilizes, buying ES, because, or even NQ, because the move is going to be driven by NQ. The Russell 2000 should be the preferred long-term instrument, but it can't make any headway because of financials. Financials are not in demand. Financials are just not being sold as hard as they should be, because people are afraid of much higher prices via NQ or ES. But that at some stage will stop. The super cycle is still there, out of expensive US industrial and non-XLK stocks and into European and emerging market stocks. That has not stopped. That is probably just at the beginning of a very important cycle that might last 5 to 10 years. And in DX, as we've told you, at the 96 area, it is far more likely to trade 99 than just to keep on going. So we will be looking to buy it at 96 for a quick trade up, and then reshort for levels around the 90 to the 93 area by the end of the summer. Thank you very much indeed, and happy trading next week.